That fast, millions of shares are traded on Wall Street, literally faster than that. And there's an entirely new system, which is being called high-frequency trading, which basically allows some trading firms to see other people's orders, and because their computers are faster, to get in before those orders. So they see them, they know what some of the price issues are, and then they can get in front of it. And guess what? New York Senator Chuck Schumer has come out and said we need to ban this. Joe Saluzzi is co-head of equity trading for Themis Trading. He also thinks this so-called high-frequency trading is a bad thing for many people, right, Joe, and that we need to get rid of it. But explain, first off, I don't know if I did a good job explaining how it works. Yeah. People at home say, what the heck is this?
It's been around, believe it or not, for a while, and it actually exploded once Reg NMS was passed in 2007, which was an SEC regulation. But it encompasses a lot more than just the flash order that Schumer is after, which he did a good job on. It also encompasses something like they co-locate their servers. They have advantages.
What does that mean? I don't know what that means.
It's a pretty complicated thing, but basically they take their computer and they physically put it right next to the New York Stock Exchange server. So they have an advantage. But let me back up for a second. I don't have a problem necessarily with high-frequency trading because they're not breaking any rules as is. What we have a problem is there should be some rules. There is an unfair, not a level playing field right now going on between retail and institutional on one side and high frequency on the other side.
So in my take, this is how it works, and tell me if this is a bad analogy for people at home, okay? So I want to buy a share of Intel for, say, $30. Stock's at $29.75, and I put in a market order for $30 a share. You're a high-frequency trader. You're able to see my order at $29.75 or going for $30, so you think the stock might tick up because I'm above the current price. So you're able to see my price and then put it in an order faster to maybe capture some of that upside.
In essence, that's what a flash order is. NASDAQ calls it a flash. Other guys call it bolt and so on. But they get a half a second or a sub-second look at an order as it's coming in. So they can
nobody's actually looking at it. I mean, it's a computer.
No, it's all computerized.
No one can look at anything that fast and make a decision.
Here's the
computer. It's all computer.
This is it. 70% of the volume that you're seeing across the major exchanges is done through the high-frequency trading model. That is too much, in our opinion. They control too much of the space, and they have too much say in what's going on. And the exchanges, this is where the real problem is, they are courting their flow. They are giving them anything they want, co-location, rebates, all of these flash orders, and meanwhile, the retail has no idea what's going on.
What's interesting is we've got a story today from Sandra Smith about how, once again, people are looking at oil speculators and want to blame them for the run-up in prices, where it seems like something like this is going on in the stock market. We got 200 and 300 point swings in the Dow, almost, not on a daily basis. It's the summertime, but when things are hot, 200 and 300 point swings.
That's right.
It's kind of the same thing.
Well, everybody loves when the market's going up and no one wants to look. But guess what?
Unless you're an oil trader, then it's bad if the market goes up.
Well, unless you're a short seller, too. And they're not having a good time over the last couple of months, I can tell you that. But here's the problem. If the high-frequency trader decides to shut down the machine, they have no requirement to provide liquidity. They can walk away tomorrow. What happens to the 70% of the volume that you currently have in the market of, say, of a 10 billion share a day? 70% is gone. You now trade 3 billion shares a day. There's a major market news coming out. Good luck getting out of your stock. You're going to plummet that stock. You're going to plummet the market. So we're concerned that these guys have...
Let's show your ideas to our viewers. You've got a couple of ideas that need to be done.
We have some suggestions that
you just want everybody to be on the same
level playing field. Hey, people have called me a turtle, old-fashioned tape reader. That's not the case. I have no problem with computers. I use computers during the trading day. I have a problem with an unlevel playing field. Yes, some of our suggestions are get rid of this co-location. You don't need it. Why does one investor, because he could pay millions to the New York Stock Exchange, have an advantage over the guy with a retail Ameritrade account? Get rid of the rebates. Why do we need rebates, which basically say to a broker, you can get a liquidity rebate if you post liquidity on my exchange? You don't need that. That was a model from 10 years ago.
The defenders of this will say, they use the liquidity word, right? They'll say, we add liquidity to this system.
It's not liquidity. It's volume. Liquidity is somebody standing there saying, I'll buy 50,000 right here. It's not somebody saying, oh, my God, here comes a seller. Get out of the way because I don't need to buy that anymore. They're not real. They're fake volume producers. They're not real market makers. They wish they were real market makers.
You think it's getting any traction? I mean, Schumer's a pretty powerful guy. So if he's out there saying, we need to back up on this, you think it's going to go anywhere?
He scratched the surface with the flash orders. Talk about the co-location. Talk about how the exchanges are regulating these guys. Let's really take a look at the exchange model and whether or not they're protecting the investor or they're protecting their shareholder.
There you go. Joe Saluzzi, Themis Trading. It's amazing how fast this stuff happens.
It is.
All right, Joe. Thanks so much.
Thanks, Brian.